If you're just joining us here on the Inside Track, we're talking about the war brewing in the steel industry over iron ore prices. We continue the discussion now with Chuck Bradford of Affiliated Research Group. Chuck has been covering steel for more than 30 years. Talk about perspective. And he's received top honors from Institutional Investor and the Wall Street Journal multiple times over his career. Chuck, we had Raphael Biederman and James Lennon from London talking about the impact this may have on steel prices. The guidance we were getting from them is that this is really just going to correct contract prices to spot prices, what we've been seeing in the market, and make it, but ultimately, it's going to make it more expensive for steelmakers, correct?
Absolutely. The big key was that when prices of iron ore weakened, a lot of people that had higher priced contracts didn't fulfill the contracts. Well, the companies don't like that. Now they're going to tie the two prices closer together, and hopefully people will honor their contracts.
Let's talk about pricing power for a moment, because Lakshmi Mittal of ArcelorMittal told us in London yesterday that he expects steel prices are going to have to rise 21% as a result, and he is absolutely determined to pass on his higher costs to consumers. Do the steel makers, who has the pricing power here? Can the steel makers effectively set the price, or is there going to be pushback from their customers?
Well, keep in mind, most of the steel makers outside the U.S. will be getting hit the same way on the iron ore increase. So they all have the same incentive to raise prices.
That's because they use iron ore as a raw material.
Iron ore and coking coal.
Okay. Now, what about the steel makers here in the United States? You just drew a distinction. Is there something different going on here?
Yeah, absolutely. The major producers of iron ore in the U.S. is a company called Cliffs Natural Resources, which sells its iron ore based on indexes on cost. Some market related, but last year, for example, iron ore pellets in the U.S., around the world, fell 48%. In the U.S., they only fell 11%. So there's a lot more stability.
Okay, but either way, if steel prices are going to go up in Asia and they're going to go up in Europe, they're consequently going to have to go up to a certain degree here in the United States. What is the impact going to be on the end user? The General Motors, the Fords, the Westinghouses, the people who make appliances, soup cans, whatever.
Okay, well, the steel content of a car is only worth about 4%. So if the price were to even double, it's not going to have that much impact on the cost of a car.
It may not have that much impact on the cost of the car, Chuck, but the profit margins on a car are razor thin, 1 to 2%. So if you raise the cost of steel by 30%, you might be wiping out the profit margin on that car.
But keep in mind that the steel margins are also razor thin. In fact, most of the steel companies lost money last year. Some are going to lose money in the first quarter. So they've got to get back their cost increases. And in the U.S., the cost of steel scrap is critical, and that's going to go up $50 next week.
Okay, so what's going to happen? Are we going to see the price of a car increase? Are we going to see the price of a dishwasher increase as a result of this?
I mean, all the related products have to go up. I mean, this is too significant a commodity.
Can you possibly ballpark the impact on the economy?
When it gets to the economy, steel is just too small these days. You know, it's not even a couple % of the economy, but it does have some impact on a number of products. For example, a Caterpillar tractor. The steel content's a lot higher than for a General Motors car.
All right. Obviously something we're going to have to look at. Chuck, thank you very much. Great insights on the war brewing in the steel industry. Chuck Bradford from Affiliated Research telling us we are going to see prices rise, but we have to look overseas to see how it balances out.